Good morning and welcome to our Value Series on Tax Planning, Year-End Tax Planning webinar for business owners, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface, and you should see something that looks like this on your own computer desktop in the upper right corner. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. This webinar is offering 1 CPE credit in taxes, and you will need to respond to 3 of the polling questions to receive credit. If you are having difficulty responding to a question, it is recommended you come out of full screen mode to respond. CPE certificates will be issued within 8 to 10 days via email. A recording of today's webinar and a copy of the PowerPoint slides will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Chris Migliaccio, partner with PKF O'Connor Davies. Chris?
Thanks, Arlene. Welcome, everyone, to our year-end tax planning webinar for businesses. Some of you may have joined us. We did one for individuals about an hour ago. Today, I'm going to be joined by Joel Rothenberg, who's a partner at PKF O'Connor Davies Advisory. He's going to be talking about some federal tax considerations, planning considerations for the end of the year. I'll be also joined by Director Nick Rochedieu, who will be talking about state and local tax issues at the end of the year. And then I will be talking about some issues. Somehow we're still talking about the employee retention credit at the end of 2023. So I'll be talking a little bit about that as our firm's employee retention credit leader. With that, I'll turn it over to Joel and start talking about our topics today.
Good morning, everyone. Just want to wait till we get to our slide. So I'd like to frame my discussion on the federal tax slides that I'm going to be discussing as though you're at the year end and you're looking to take money out of your company to spend it on a vacation or to buy a personal asset. And you need to consider what I'm going to talk about, because there could be some traps and surprises come April 15th when you get your tax return. So I'd like to be able to frame that discussion as I walk through my topics. Next slide. So the first one I want to talk about is the depreciation rules for 2023. Generally, we have 2 sections that we deal with. The first is bonus depreciation, and the second is what's known as Section 179. I'm going to talk to you about what the differences are and what the planning techniques are that we engage with our clients at the end of the year. So bonus depreciation generally applies to property with tax years 20 years or less. It is including new and used property. You can take bonus on most anything with a 20-year or less, such as land improvements, things like that, but also computer software and what's known as qualified improvement property. This is improvements to the interior portion of commercial buildings. As you can see from the percentages, they are decreasing. Right now in 2023, you're allowed to take 80% of the asset's cost as immediately expensing it for depreciation purposes. The 80% will go down in 24 to 60%, in 25 to 40, and 20% in 26, then 0 after that. Of course, if Congress decides to increase the percentages, that's always on the table, but currently this is what the law is right now. Section 179 is now statutory with the amounts. The maximum deduction in 2023 is $1.1 million, meaning that you can expense up to $1.16 million worth of fixed assets. However, under 179, you can only deduct the cost up to taxable income, including wages. 179 cannot create a loss, whereas bonus can create a loss. If you have a large purchases this year and you've made substantial improvements or acquisitions, there is a phase out under 179. And the phase out begins when the asset cost is at $2.8 million and it's fully phased out at $4 million. Now, the planning that goes into a bonus depreciation or 179 is first off, 179. A lot of the states follow that. They haven't decoupled from 179. Therefore, if you have a 179 deduction of $100 on your federal return, generally the states will allow that $100 deduction. Whereas on bonus, a lot of the states have decoupled, meaning you do not get to immediately expense that amount. Under the state law, you'll just depreciate it over its normal life. So there will be a depreciation difference between the federal and states. Generally, what we like to do is take 179 first with our clients, especially if it's multi-state, and then take bonus afterwards. The key with bonus, though, is that you can create a loss with bonus depreciation. So that would be part of the planning. We would look at what's going on with the client in 23, 24, and 25. To determine whether we should maximize that and create a taxable loss that would be carried forward into the future years. The one trick with bonus is there is a provision, it's an interest limitation provision. If you create a loss, you might end up limiting your interest expense depending on your gross receipts, which in 23 is $29 million. So if your company has a 3-year average of $29 million, if you create a loss taking too much bonus, you will end up limiting your interest expense, and that is something that we work with our clients to avoid. Next slide. Another provision that went into effect, and it really upset clients in certain industries, was the requirement under 174, which came out of the Tax Reform Act, to capitalize and amortize specified research and experimental expenditures. Prior to this law, companies were allowed to deduct their research and development expenses. However, to offset the decrease in tax rates, Congress imposed a capitalization requirement on research and development expenditures. These include laboratory and software development expenses. Research that is conducted in the US is amortized over a 5-year period. Research conducted overseas is subject to a 15-year amortization period. You have to be aware of this because this will increase your taxable income come April of next year. The key here is to only capitalize what is required to be capitalized. The IRS has since in October issued notice 2023-63, which provides more guidance of what we have to do, and they're going to be issuing proposed regs on this section. A lot of people in the community are advocating for this law to be repealed or changed. There was a bill drafted last year to do that. However, Congress has not acted on it, and as of today, we are stuck with the law as it is currently drafted. What we do with our clients is to make sure that we're only capitalizing those specified research and experimental expenditures. Any other deduction that we can find would be a normal trade of business deduction, and the client will be able to deduct that against gross income in that year. We have had clients come to us and say, well, we didn't have any R&D this year, so therefore we don't have to capitalize anything. However, if you looked at their history, they did claim the R&D credit. So we talk to our clients that is going to be an audit flag, that if you had R&D in the prior years, you're really going to have to be able to substantiate that there was no R&D this year. Now, just because you have to capitalize the R&D expenses, that does not mean you shouldn't claim the credit. The credit will help offset the increased tax liability resulting from this provision. Next slide. So on top of bonus depreciation going down to 80%, the capitalization of the research and development expenses, there's also limitations on the losses that were imposed by the Tax Reform Act. They were stretched out due to the pandemic rules, but we are currently facing those limitations in 2023. I'm going to go through the 2 sets of rules, and then I'm going to go through an example. So in the current year, there is what's known as the excess business loss limitation. Essentially, this means that you can only deduct your losses in excess of your trade or business income up to a statutory amount. So if you're a single taxpayer, that's $289,000, and for a married filing joint, that's $578,000. Any excess loss above those amounts will be treated as a net operating loss in the subsequent year. To make matters worse, net operating losses are now not fully deductible. They're only limited to 80% of taxable income if they were incurred after 2020. If you have net operating losses that were incurred pre-2021, they would still be 100% deductible in 2023. So we had a lot of our clients who traditionally didn't pay tax because they had huge net operating losses, whether because they had a real estate interests or whether they had startup companies where the losses passed down to them, and we suddenly had to tell them that they had to owe taxes in April, even though they were forewarned on the fact that these rules were coming into place. However, there are planning opportunities that are available to minimize the impact. So I'd like to do an example, which is on the next page. So my example is as follows. It's 2023. You are a shareholder in an S corporation and you have losses of $10 million. In the same year, you have wages of $500,000 and you sold stock for $9 million. You are a single taxpayer. Therefore, you're subject to the $289,000 limitation. If you did not plan for this and you sold the stock and incurred the losses, and you spoke to us after December 31st, your 2023 taxable income would be $9.2 million. How I got to this number is the wages of $500,000 plus the stock gain of $9 million, less $289,000 of losses. Of the $10 million of the S corporation losses, you can only deduct $289,000. The balance of those losses, $9.7 million, is carried forward to the future years. So you have to think about in the future year, how much income are you going to generate in order to fully absorb that net operating loss. However, with some planning, we could have minimized that tax impact. If we had spoken to the client, we would have seen if we could defer the stock gain until 2024. If we had done that, taxable income in 2023 would only be $211,000. That's the $500,000 of wages less the $289,000 of exemption losses. In 2024, assuming that your income was only $9 million from the stock gain, then 20% of that $9 million would be subject to tax because the balance at 80% would be absorbed by the net operating loss. This would have resulted in substantial tax savings to the client. So while these rules are in place, there are ways to plan around it. However, we need to be able to communicate with the clients, and the clients need to be able to come to us when they have a tax event during the year so that we are aware of it and be able to plan and minimize their taxes. So the key pieces on these slides are that there could be taxes owed when you think you're in a loss position. So it's important to, number one, plan for the depreciation expense, meaning that if you want to do a large purchase, this year bonus is at 80%, next year it's at 60%. If you're looking to make the acquisition, no matter what, now would be the time to acquire the asset. A key piece to that is that the asset must be placed in service by year end in order to claim the depreciation. If your company has research and development, it's important to talk to us in order for us to minimize the amount that's capitalized and treat the other deductions as fully deductible in a year, and also to go and examine the R&D credit if you have not pursued that in the past. Finally, on the losses, you need to come to us before year end so we can take a look at your what happened in 2023 and try to minimize the impact of these excess loss limitations that were imposed by the Tax Reform Act. Thank you.
Joel, there's a question as we come up to our first polling question, just about how do you defer capital gain on the stock, and just sort of the general thoughts around, it's someone in that scenario who came to you, what do you tell them?
Well, if they think that they can not sell the stock and generate the gain towards the end of the year and still realize the same economic benefit, they could sell it on January 2nd. Obviously, if the sale occurs in the beginning of the year and this is something that that you needed to take off the table because you didn't feel the stock was going to depreciate, then by all means, tax should not wag the dog. You need to take the gain off the table. There are other provisions that allow you to defer the gain on the sale of stock, such as investing the gain in what's known as opportunity zones. So there's other mechanisms that are available under the tax code in order to defer the gain into future years.
Thank you. Yeah, it's a good and sort of important point, the way that particularly if you have a flow through business, right? Your personal income and your business income are going to work together. They're going to play together, and you've got to be thinking about that as you're going. And especially as you get towards year end and thinking about, again, if you have those choices about when you're going to trigger gain. Most people got it right? So bonus depreciation in 2024 will be 60% of asset value, down from 80% in 2023. It's an important thing to sort of keep in mind. TCJA, I feel like generally has a lot of these sunsetting provisions, things that change in various ways over the course of the length of time that it's in place. And again, a lot of the provisions will sunset after 2025. So it's something to sort of keep in mind at the end of each year. I think we'll be having these sort of same conversations about, well, what's changing next year? Even the R&D thing, right, I think was a little bit under the radar, in part because it was sitting out there for several years, but it was something that only came into play in 2023.
Yeah, and I'll just add that last one, regular depreciation applies. Bonus depreciation isn't required. It's an election. So if you want to go regular makers, acres, etc., you can. That's one that, and I would say it bolt together. So thank you, Joel. And I would say bolting together the 174 R&D change. There is some analysis that can be done if you happen to be an asset-heavy industry or asset-heavy business, that if bonus depreciation can offset your R&D capitalization amortization, there are a lot of clients that are sort of working through that, not only for 22 but 23 as well. So again, thank you, Joel. I'll just add from the R&D issue, it is always a good time before we get into the individual state level considerations to look at credits globally, both from a federal and a state perspective and locally. It's that time of year to look at your current year spend and your prospective spend from a budgetary standpoint. If there's something you can do to maximize those dollars you're investing in, whatever that happens to be. So credits wise, whether it's R&D or something else, it's worthwhile to reach out to your advisor and find out. So next slide, please. So we'll hit the high notes here and then we'll go into some more detail on each of these. Key considerations for year-end pass-through entity tax, and determine how much a benefit exists. And as Chris very aptly mentioned, the state and local tax limitation sunsets at the end of 2025. So there are two states, Massachusetts being one of them, that actually bolt their pass-through entity tax to that date. Otherwise, everything else exists. And Chris, actually from our last webinar, made a good point that there's a administrative burden aspect to this, that if there's a pass-through entity tax capability, you sort of have going hand in hand with composite returns. Do you file the pass-through entity tax going forward? Now, obviously for 24 and 25, I think it makes sense. Generally, it's if, but usually how much of a benefit exists to push it up to the entity level, because you'll get the deduction at the entity level and a credit at the individual level. But really, it's going to be a calculation going forward. So for now, pass-through entity tax generally makes sense. And I would say especially we've seen a significant amount of transactions that have taken place in the last year or so, where pass-through entity tax actually is much more beneficial than not. And I say that from, if you have a huge gain triggered somewhere, especially if it's at the entity level, if the entity continues on its existence, on its merry way, it makes a lot of sense to have the deduction for the taxes related to that transaction at the entity level, and then the benefit sort of flows down to the individuals. So election deadlines.
Real quick, Nick, just on that point, that a lot of times business owners think I'm better off selling the stock of my business. But if you are a pass-through business like an S corp or a partnership, it's worth modeling that out, because sometimes it really is a significantly better scenario to sell assets for tax purposes than to sell stock because of the pass-through entity tax. It really, again, it's very fact dependent, very dependent on the profile of the business and the assets and how much the gain is, things like that. But always just sort of worth running through that, because the default is not always true given the limitations.
Absolutely, and this is where the planning part, and agreed. I think the model, the with, and I always say it's the with and without. It's with versus without, and then sort of secondarily, the election deadlines. It sort of segues very well together. Can we take advantage of it, and what does that look like? So most pass-through entity tax elections are irrevocable. So for example, if you opt in, and we'll talk about New York very shortly, but if you opt in, you're stuck with it. So if there's a transaction, if it's detrimental to you, there's nothing you can do about it. So absolutely, Chris, you make a very valid point where I think it's something that you would want to reach out and say, exclusive of your traditional Q of E, exclusive of your multiplier analyses that take place, you want to look at pass value tax in, is it a stock versus an asset deal? And what does that actually, what's the benefit or detriment look like? And the modeling is important there. So the election deadlines, we'll talk about that briefly. An estimated payments deduction timing, and this is a cash versus accrual discussion point. If you're a cash basis taxpayer, you want to get the deduction in the current year, make your payments if you think you're going to have something due. If you're an accrual, there's sort of the recurring item discussion that needs to take place. We're always on the much more, I would say, conservative side of things, saying that if you're going to have a deduction, it would be beneficial, depending on what your cash flow looks like, to make it before the end of the year. So you can deduct it in the current year. Obviously, there's some discussion, I would say, out there about that. If you're an accrual taxpayer, so far, I don't think that's been challenged, but generally, we say if you have the cash and are able to make the payments, make them before year end. High level, and I'll say we're going to get into this in more detail in later slides, but from a Nexus perspective, and this is for both corporations and partnerships, it's really we've faced a lot of the same as last year. We've been filing this way for 20 years. We've filed this way for 10 years. We've filed this way for 5 years. That really doesn't apply anymore for a whole host of reasons. And one of the things that we really try to focus on and really try to let people know is before you get to year end, even before you get to 12/15, if you're looking at Q4 estimates, whether it's a partnership or a C Corp or an S Corp, et cetera, really look to what your filing profile looked like historically. And this is the time to take the hour, 2 hours, 5 hours, whatever that happens to be, and say, is there something that we should be filing or somewhere we should be filing that's really going to save us some headaches later on? Now, I'll be very clear that the benefit is, yes, you've sort of checked the box. You've done, and not checked the box in S Corp LLC perspective, but check the box that you started tolling the statute of limitations. However, there's an administrative burden that comes with that. And with that administrative burden, there's a little bit of materiality that goes into it. There's a little bit of business decision making that needs to go into that. And depending on how risk averse you are, there's some folks that say we want to file everywhere we have $1 of income versus not. That's sort of I would say much more of a judgment call than anything else. However, corporations, C Corps, and generally, and I'll say generally, we'll talk about more a little bit, S Corps, there are more bright line tests now than there ever have been. States have realized that, first of all, we'll talk about Wayfair as well. You can see it right there on the slide. Certain states have really said, listen, it's easier for us to not fight Nexus questionnaires, to not fight at audit, to not fight on appellate. It's easier to say, listen, if you reach this threshold, whatever this threshold happens to be, 100,000, 500,000, $1 million, this is what we're going to do. And California obviously has been one of the front runners with their very specific index to inflation. Like last year, 637,000 in sales, 63,000 in payroll, and 63,000 in property. But really, that's sort of the coming wave, I would say, is that it's a lot easier for states to point to it and say, if you've got over X, you should do something. Now, partnerships on the other side, and we'll talk about this in depth, but partnerships, I say this only from, there's a multi-state tax commission proposal currently. And I say this as I read it and couldn't believe it, and so I had to put it on the slide so I actually can see it and believe it now. There's a multi-state tax commission proposal right now, which again, states can either fully adopt, not adopt at all, partially adopt, et cetera, or model their own statutes against it. There's an MTC proposal currently that says if you're a partner in a partnership with Nexus, doesn't matter if you're passive or active, means you have Nexus there too. And that expansion of Nexus is beyond the cookie Nexus, beyond Wayfair Nexus, beyond pretty much anything that's been seen in recent history. However, it's out there, and if there's a partnership Nexus rule that starts to go into effect, we're going to start to see it be pretty significant, especially when you've got tiered partnership structures. Next on the Nexus front, just from an aggressiveness standpoint, sales and use tax in Wayfair, that turns 5, 2018 and 2023. The real view here, and the reason that sort of we want to focus on this is, if you haven't done a Wayfair analysis and you happen to be selling anything, whether it's services, goods, et cetera, it's worth taking a look to say, hey, is there something out there that we're not aware of? If there's something out there that we're not aware of, or at least we can track it and quantify it, that's more beneficial to us than not knowing. That great unknown we've seen in a number of transactions, whether it's within a sale, merger, et cetera, purchase side of things, becomes a problem. And it becomes a problem that can become very significant when you start to multiply it by 3, 4, 5 years out. So lastly on this, from a key consideration side, is from the audits. We have seen, I would say, at least triple, if not more, the level of audits, a number of audits that have been coming through for sales and use tax. On the real estate property transfer, controlling interest transfer tax side of things, transactional taxes in both those top two have been significant. So whenever you're selling something, whether it's real property or selling essentially, it doesn't even matter. Selling a partnership interest, that's become a much more highly focused area for audit. And sales and use tax, states are looking for money. Even though, for example, like Ohio actually just said we're not going to do amnesty because our economic shape is relatively good. The moment things sort of turn south, and with a sort of confluence of interest rates, depending on what your view on inflation is, and depending on what your view on is the 4.9% of GDP, our presumption is at some point in time that's going to become a much more focused area of states are looking for cash somewhere, especially to retain the spending levels that they've enjoyed over the past few years. And lastly, on the audit side, from a state and local perspective, obviously work from home has been a big area, and payroll and withholding audits are starting to ramp up. And that's from not only convenience of the employer rules, that's also from where are your folks working from home. And essentially, if you've got somebody who's going to file an unemployment claim, and let's just say things turn south, you start to lay folks off or separate folks. If they start to file unemployment taxes, there's going to be a matchup. And if you haven't been withholding unemployment tax and they file in their home state and you've done unemployment tax somewhere else, we expect there to be a significant amount of Department of Labor audits that are going to take place in the near future. So go to the next slide, please. So not all doom and gloom here. What I'll say is that just high level from a passive entity tax perspective, things that have changed, and I say change from, coming into line with other states versus something a little bit different. Connecticut has now made the passive entity tax optional in tax years 2024, 1/1 going forward. Historically, from 2018 when it first came into effect, Connecticut was mandatory, now it's optional. So that modeling Chris mentioned is sort of going to be more important than it otherwise has been, because Connecticut was always a given. You had to file that way. It didn't matter what you wanted to do. And Connecticut, with the reduced credit of 87.5% compared to 100% in most other states, excluding Massachusetts, Joel, I'll give you credit for that. With that being said, there was a belief that if all you have to do is pass serenity tax, then you're good to go. Connecticut and Mass are not that way. So something to keep in mind. Now that it's optional, is it worth the administrative burden to not get the 87.5% credit or Mass's 90% credit? Shifting to Massachusetts, my neighbors to the north here, the millionaire's tax study, Massachusetts put in a 4% surtax if you have over $1 million in income. And there was some married filing joint versus married filing separate questions about that. Massachusetts realized that, hey, guess what? Our passive entity tax is actually statutorily driven at 5%, which at that point in time was the incremental or marginal tax rate in Massachusetts. Now, fast forward a little bit, that's now 9%. And the legislature has directed the Department of Revenue to actually start to take a look at, should we actually have passive entity tax at 9% versus 5%? So that tax study presumptively, I'd say presumptively, because we all know how fast states administratively move things forward, it's supposed to be in 2024, which would also come into line with you can't file married separate anymore in 2024 going forward. So interesting events happening in Massachusetts, sort of a to be continued and stay tuned. The next one is New York. The only thing that really rationally, I'd say rationally, because there's a few things that were irrational in there. The one rational item that came out of New York's budget really was taxable income excludes deductions for passive entity taxes paid. It used to be a circular reference where you said your New York PTET is calculated based on a deduction of PTET paid elsewhere, and you get into a circular reference of if I deduct it, it lowers my taxable income, which would lower my tax, which would lower my deduction, etc. They've now come out and very definitively said taxable income excludes any of those deductions. So your gross in that case, you're sort of set with it. Lastly, on this front, election planning, and I always say this from folks, regardless if you have a transaction or not, and this has become, I would say, very important, is probably the wrong way to put it, probably too mild the way to put it. If you're looking at transaction, or if you're looking at sort of a regular going concern, keep an eye to elections. New York is very contemporaneous. You have to elect for 2024 before your Q1 estimate is filed, and you have to file a Q1 estimate. Massachusetts, you've got to make sure the 63D-ELT, that election is filed. Now you have until the extended due date, but you have to make sure that you sort of check these administrative boxes off so that you've got it as of that day. New Jersey, for example, by the original due date of the return. So if you come into early 2024, you've got to make sure you don't have the benefit of the extension. I use those as sort of highlights. There are a bunch of other states, for example, I try to focus on Northeast. A bunch of other states that really focus on this as the administrative deadline is the key. If you don't get it, you're going to lose out on a benefit. And again, I'll keep referencing back to Chris's comment from earlier. You really want to focus on that modeling. If it makes sense for you economically, which I would say the vast majority does, it's worthwhile to really make sure, not only from what I'd say is a client service perspective, but even if you own a pass-through entity, that the right things are being done at the right time. And before we go to the next slide, just very quickly, just to focus on three main sort of components. You want to focus on your filing profile. Where are you filing? Where should you be filing? And what does that mean? You should be focusing on sourcing, which we'll talk about on the C Corp side, but it's very significant for pass-through entities. And lastly, from a transaction perspective, really focus on your transactions. If you're thinking about it, whether it's in the future or it's something that's contemporaneously happening, we've seen a lot of pitfalls where folks will look at it after the fact and realize, if I had only done X, Y, and Z, we could have done something. So similar to Joel's example from earlier, we want to get ahead of that, and we're trying to focus on really what's the transaction, what's your exit strategy, what's your introduction, are you looking to buy something, sell something, how can we make that beneficial from you, sort of from a state tax perspective. So next slide, please. So moving on to sort of some of the meat of it, and this is really focused, unless I mention otherwise, focused on what I'll call the C and S Corps of the world, just because that's where the vast majority of this exists, and I'll explain why I say that. One of the things usually this time of year or a little bit earlier, some clients are great, some clients look at it sort of towards the end of the year, pre-extension time. Where should we actually be filing? And I'll say that there's one big distinction I want to make very clear to everybody on the phone or webinar. There's always a question of, should we be filing something? And the second question is, if we do file something, what's the liability? And that's where there's some sort of managerial expertise, managerial determinations, and risk averseness or not. Depending on how conservative or aggressive you want to be in this area, you could say, listen, we have nexus in 35 states, 40 states, doesn't really matter. However, I'm not going to spend money to pay a return and file a return and pay an amount of $10, $15, whatever the minimum tax is, if I know it's going to cost me a multiple of that to actually file that return. So with that as the backdrop, I wanted to focus on nexus and sort of the three sort of very broad areas of physical presence. And this is for C Corps, S Corps, partnerships, LLCs, you name it. Do you have people or property somewhere? Now, I'll use California as an example. As I mentioned earlier, California has a very set dollar threshold. If you have below this amount of payroll, you are not subject to income tax. And I'll say income tax from, whether it be pass-through entity tax, pushed down from pass-throughs to individuals, or C Corp, S Corp entity level tax. If you have people or property somewhere, you should be doing something. Or if you don't do something, you should be just at least be aware of it. I tell folks that the easiest way to do this is from a people perspective. Where do you have W-2s or 1099s? And if you don't know from a work from home perspective, and we'll chat later on, just send us an email. We can talk about that in further detail. And where do you have property? Now, some folks will say we have hard assets, machinery, equipment. It's very easy. We have warehouses, distribution centers, etc. Property versus if you've got a couple laptops somewhere, it's a materiality question. Physical presence is sort of the end all and be all here. If you happen to have physical presence, you're going to trip up something, and it's a question of if there happens to be factor-based nexus that saves you. Factor-based nexus, do you have a certain level of sales, certain level of property, certain level of payroll that actually has you sort of there? And then lastly, and I say factor-based, it's very black and white. The question isn't measurement, it's do you have sales? What do your sales mean? It's sort of spelled out in the statutory references. The last part from a broad nexus standpoint, and this I'll sort of loop in our S Corp, C Corp, LLC partnership folks, there's very broad nexus. And by broad nexus, there's either what I'll call, and I'll use air quotes here, a doing business standard, or there will be a who must file standard. And I say that from the who must file could be if you have income derived from the state, you should file something. And that's where the materiality and the business decision comes into play. From a partnership LLC standpoint, same deal, but much more so on that side of the fence than on the C Corp and S Corp side. They may not have factor-based nexus because those statutes are only into the chapter that regulates C Corps and S Corps. On the partnership side, it may just be, listen, I looked at my insert state abbreviation -1065. It says, who must file is anybody who derives income or expenses from the state. That's one where, again, you've got to look at your same as last year. What does that profile look like? And what does our liability possibility look like? And that's where the quantification comes in. Not only do we have nexus, but what does that mean for us? And what I'll say here as an income tax, and I always sort of have it as a slash, but I didn't put it here because I didn't want to confuse the slide too much. You've got gross receipts taxes. And gross receipts taxes don't particularly use these nexus thresholds for the vast majority, but they'll look at sales thresholds. So sometimes on the factor-based nexus, you always want to keep in mind that some of the other things we're going to talk about have sort of an irrelevant application, sort of A6272, which we will chat about. But keep in mind if there's a gross receipts tax. So if you exist in Nevada, Ohio, Texas, Oregon, Nevada, Washington, keep an eye to if you do business in those states. It may not be traditional income tax, it may not be traditional sales tax, but there are gross receipts taxes out there that you definitely want to keep an eye to. So sales tax, which everyone's been beat over the head with for the last 5 years, Wayfair decision. The bright line, there's a threshold, everybody knows, $100,000 and or number of transactions. Some states are a little bit higher, but the vast majority are 100,000. What's the measurement period? Is it a rolling 4 quarters? Is it a year? Is it monthly, etc.? And then what's included? Our resale, sales for resale included, our marketplace facilities included or not. And that's really we know we've reached the threshold, whether it's calendar year, fiscal, quarterly, monthly, whatever, then what do we do about it? So next slide, please. So let's talk nexus, just high level from an income tax perspective. And again, this is, we'll say for the moment, C Corp and S Corp focused, but a couple of these will be really partnership and LLC, and I'll mention that. A6272 was a law in the early 50s dedicated to you have certain activities, you won't be subject to income tax nexus because you only solicit for sales. There's a whole host of things in that public law, A6272, that go through what you can and cannot do. Does it apply? It's only for the sale of tangible goods. Be very clear, only the sale of tangible goods. If you have any services at all, whether it's blended with goods or not, there's a separate analysis for there. Does it apply or not? If you're selling widgets, fantastic. The problem here, and I'll say the problem is, there's some sort of internal discussions that are taking place in this now. The Multi-State Tax Commission, which we mentioned earlier, has come out with sort of their own standard in 2021. New York and California have come out with their own standards in essentially recently in the past 8 to 10 months. And A6272, which used to be a shield pre-internet age, has now dwindled significantly. So for example, and Joel, remember this, the cookie nexus in Massachusetts, if you had somebody put a cookie on your computer, that meant they had nexus. That's essentially where A6272 is headed, where it used to be a shield that was, we'll say Roman size or bigger, sort of Highland Games type shield, to now where that shield is very minimal and very small applicability. You need to understand what the risks are associated with that. So exclusive of that, and again, it's very limited application, but it can exist, and it does exist. It's just a question of that, how it applies and how you can make it apply. The next is apportionment method or sourcing. You really want to figure out a nexus for perspective of whether it's a bright line test or otherwise, how are you sourcing it? Currently, there are more than 10 states that are still on a cost of performance where you actually do the services, where you actually create them. So for example, if it's delivered electronically somewhere else, but you do all the work where your employee is sitting, versus market-based, which is the vast majority of states where are sort of existing now. That's really focused on the services side. And even on the tangible personal property side, where is something delivered? What does that mean? If there's a drop shipment agreement, if it's flash title, inbound sales, for example, with the amount of importing that's being done now, that's become a much more complex area than it ever has been in the past. And then lastly on that, who is included in the return? From a C Corp perspective, C Corp and S Corp is a little bit different, but from partnerships, usually you're just filing out the entity because you've got owners that are going to get K1. It's that simple. When you're in the, we'll say the C Corp rule to keep things simple, is it a unitary return or not? Do you have somebody that's related to you enough that once one entity is in, everybody comes in? And then what does that mean? What does that unitary analysis look like? And I tell folks, anytime I hear that there's an org chart that has more than 2 or 3 branches, sort of from the parent company down, first thing I do is I ask, how are you filing elsewhere? If there's a unitary relationship, is there flow of value? Is there centralization of management? Is there common ownership? That question's got to be raised. That's a big part of year-end planning for figuring out how you're going to actually file somewhere. Now, sales tax, we talked about this. When did Nexus occur? This is really a looking back in time and looking forward in time. What does that mean? And that goes down to our overall. What is the exposure currently? We're in November 2nd today, if I got my dates right. What does that mean? What is our exposure currently? And what do we care or not? And I say, do we care or not flippantly, but really, if we think, listen, our net exposure is $5,000, and whether it's an ASC 740, if you happen to be under that realm, or an ASC 450, sales tax or income tax, sort of flip those, if you're worried about actually booking an exposure or not. Does it really matter? What's the risk? What's the materiality? If you realize that there happens to be material risk there, and I say material risk not in an audit standpoint, but material risk from a disclosure standpoint, what do we need to do? And how far do we need to look back? So if we are in that place, and I would say, and Joel has experienced this several times, as has our advisory group with Chris included, if there is something that's out there, nobody wants to find out in the middle of, if there's a letter of intent or there's a purchase or sale agreement, any due diligence, no one wants to find out that there's exposure for prior periods and everybody's shocked. The moment everybody's shocked, it becomes a question of, is there a purchase price reduction? Does the deal fall apart, or is there escrow or holdback? What does that do to the earnout period? So I say that only from not the doom and gloom standpoint, but the idea here is if you're intending on either becoming a purchasor or a purchasee at some point in the near future, Nexus is important, and looking at what your profile would be had you filed and what that liability might be is extraordinarily important. So next slide, please. And lastly, before I round it out for Chris's rousing ERC section, sales tax audits are on the rise. They've either tripled or quadrupled, depending on staffing at states and them getting out of the backlog of actually processing what I'll call traditional administrative activities. Watch for Nexus questionnaires and information data requests. We have had a lot of clients, and I say this to be very cautious to anybody who's a client or is a prospective client or otherwise practitioner. When we get a Nexus questionnaire, it sounds like the wording is sometimes semantic, but sometimes it could be the turn of a phrase that creates Nexus if you don't answer it properly. So if you get a Nexus questionnaire, bring it to your advisor, whomever that happens to be. If you happen to get an information data request, and this is administratively, provide what you can and work with your prospective auditor as much as you possibly can to either limit that down or identify exactly what they're looking for. This is one where you need to ask or answer the question you're asked as opposed to the question you want to answer. The easier way to do this is sort of the less is more approach in regards to whether you're going through an audit or whether you're going through the initial stages of a possible audit. So lastly, to round out my section here, be aware of administrative issues, responses, and deadlines. The last thing you want to do is end up at some sort of adjudicative proceeding later on that says, you know, petitioner was asked for X, Y, and Z, and they didn't provide anything. So be aware of deadlines, be responsive, and be upfront. Ignoring it, and I couldn't be clearer in this area. If there's anything else you don't take from this, from a year-end planning perspective and from next year's perspective, if you get a notice, don't ignore it. It won't go away. The states are getting a lot better at it, and they're like a bad penny. They will keep coming back. So with that, I don't know if there's another polling question here, but I'll turn it over to Chris for ERC. Oh, there you go, polling question. Perfect.
There's a polling question. I'll ask the one thing I'll ask you about, Nick, while the polling question is up, is just, you know, do we need to consider Nexus as it relates to passive income as well? You know, we're talking about business income, but a business might have a mix of active and passive income. You know, maybe a couple of high-level considerations there.
Yeah, so from a passive income perspective, and I'll use it in two different ways. So there's passive income in what I'll say a very traditional sense is if there's an investment account, that's a little bit easier. If there's a passive activity in another pass-through, that's where you want to dig down a little bit further and figure out, is there any way that they could impute Nexus on sort of the upper tier? So the vast majority of time, and I'll say the vast majority, if you're extraordinarily passive, I would just be concerned about what the K1 says if you're getting flow-up income somewhere where you're not expecting it. But generally, it's something we want to look at. If you say, listen, I've got sort of these two buckets, here's what these 2 buckets look like. That's one that I wish I could give a better answer than waffling. We would want to look at that, but passive, usually I would be less inclined to look too deeply in, but I want to be aware of it just so we can say, hey, you know, this is getting to be a significant amount so that we can look a little bit further into. Excellent.
Yeah, well, and our the second answer unfortunately got cut off there, so I think that's technically the right answer. You know, if state and local taxes exceed a certain threshold, that's really when passive entity tax can reduce, and so you want to take a look at that. But again, it's that it can be a benefit regardless, even if it doesn't reduce tax, you can still have that administrative benefit of having the partnership cover it and deal with the issues.
Yes, agreed.
So thank you, Nick. I'll be sort of rounding us out by talking a little bit about the employee retention credit. As I said at the top, it's, you know, it's kind of amazing that we're still talking about the employee retention credit over almost more than 3.5 years since it was enacted in March of 2020. Let's go to the next slide and kind of take a look at some of those details. So before I jump into it, just sort of the high level, what is it, right? What is the ERC? It's a refundable payroll tax credit. It was part of originally the CARES Act in 2020. Same thing that came with PPP loans and all those things in March of 2020. It was used by very few businesses in 2020 because its use was prohibited for those receiving a PPP loan. So it was one or the other, and the PPP loan was a much more beneficial path to go down. So very few businesses were thinking about the ERC. But later legislative acts in December of 2020 and then early in 2021 removed the prohibition for PPP borrowers. So you could have both. You simply had to, you know, couldn't double dip between the two. And also extended and expanded the ERC eventually through Q3 of 2021 for most businesses. There's a very limited exception that applies for Q4, but this is a very, very small, really only if you were starting a very small business after February of 2020. How does a business claim the ERC? It's done based on amended quarterly payroll tax filings. So that's why it sort of becomes a tax issue, is that unlike the PPP, although it's sort of people think about them sometimes in similar ways, this is a tax return that is required, that needs to be amended, and will also, again, end up having some impact on your income tax returns. Let's go to the next slide. So why are we still talking about this though, right? You're saying, Chris, look, this relates to 2020 and 2021. It's currently 2023. This is the 2023. You're not dreaming. You haven't passed out. You're not back in the 2021 year-end tax planning webinar. And the issue is that, first of all, businesses are still getting aggressively marketed to by shady, frequently fly-by-night credit companies. They'll tell the business that they qualify in all quarters. They'll take large percentages, sometimes 20 to 30% of an inflated credit. So the fees are very, very high. They'll tell you, they'll tell you your business may be eligible for up to $26,000 per employee. I'll talk about that in a second, but that is a very much a best case scenario and rare that you would get $26,000 for every last employee. But more importantly, they'll a lot of times they'll even send, you know, notices that look like they're IRS notices that you're due this money as long as you call someone and work with them. They're essentially phishing for you. And the issue is that a lot of times, in the IRS's perspective, there's, you know, businesses that are applying right now are not eligible. You know, the companies that are working with them are taking very, very aggressive positions, essentially fraudulent positions. And then also many times not considering the interaction with the PPP, not telling businesses that they need to amend income tax returns to reflect the credit, which is an issue as well. And so the IRS has been coming out with a lot of, I wouldn't say guidance, because the IRS is, the guidance is old in a lot of cases. But the IRS has been speaking very publicly about the ERC, especially over the last couple of months. Let's take a look at the next slide. So in a specific way, what the IRS announced on September 14th is that they're going to stop processing new amended payroll tax returns until at least the beginning of 2024. That doesn't mean that the ERC is over, but there are deadlines to file amended returns. We'll talk about those in a second. But this means that the IRS is slowing down processing, right? There's no way you're going to get the money if you file now, before the beginning of 2024. We've also said they're slowing down the processing of claims that are currently in process. This allows the IRS to do more review before paying out funds. Prior to the last, I'd say, few months, 6 months or so, we've generally seen payments be made before an audit. Now we're frequently seeing an audit occur before the payout is done. So the IRS is stepping up audits. They're stepping up their reviews. They're trying to ferret out, is this a good claim? Particularly when, again, the numbers as relate to the ERC are very, very significant. We're up to $230 billion in ERC claims. That exceeds the annual budget of a number of departments of the U.S. government. The IRS believes currently that of the ones they're receiving now or had been receiving before they made this put this pause in place in September, that up to 95% of them may be ineligible. What I would add there is that, the IRS has said 95% may be ineligible. The other thing I have noticed, again, when clients work with unscrupulous promoters, is that a client may be eligible, but the documentation of eligibility is poor. So that if the client were ever to be audited, they wouldn't have sufficient backup. They wouldn't have sufficient support to explain really under the IRS guidance how they qualify. And we found a number of clients where what they had on file was simply not enough, but it turns out with enough digging and sort of work on that they did actually qualify. And the IRS is, again, concerned about small businesses being charged contingent fees that they won't be able to recover after unsuccessful audits, that a lot of these businesses are fly by night and they'll be gone by the time the audits are done. Other thing I'd point out here, the IRS has between 3 to 5 years, depending on the quarter, to audit. But they also have, first of all, 2 years from whenever a refund is paid. So slowing down processing is pushing out the audit periods for these. And also, again, the IRS can go back as far as they want to audit if they're seeing fraud. And while you might say, hey, I didn't commit fraud, it was this company, the IRS is seeing fraud in a lot of places here. They have really significant concerns. And that's why they're putting in some programs we'll talk about in the next slide. Let's move to the next slide. So the IRS announced an ERC withdrawal program, so that if you now believe that you applied for an ERC incorrectly, and you made the claim on an amended payroll tax return, this can't have been if it was on an original tax return, although, again, hopefully all of those have been paid out by now. And you meet certain other criteria here, you can simply withdraw your ERC claim, even if you're under audit, right? So the goal here is to consider, look, if you now look at your ERC and go, I don't think I qualify, you have the opportunity to withdraw it before the IRS charges interest and penalties. They pay it out. You'll note that this only covers right now, this withdrawal program, scenarios in which the IRS has not paid the claim, or the IRS has paid the claim, but the employer hasn't cashed or deposited the refund check. The IRS has said there will be programs, settlement programs out there for those who have deposited the check and now believe that they do not qualify. So stay tuned for news on that if you're in that position. Also, you can only withdraw the entire amount of a return. You can't. You'd have to amend it if you want to believe that you qualified, but for less money than you claimed on the return. Let's go to the next slide. So this is an important point, right? Because we're in this pause right now, but as I noted, this has not changed the deadline to amend payroll tax returns. Payroll tax returns are deemed filed for these purposes, for all purposes, 3 years from the date returns are considered filed, which is April 15th of the year after the quarter. So even though payroll tax returns are filed quarterly, these deadlines are annual ones. For 2020 payroll tax returns, the last day to amend one is April 15th, 2024. And for 2021, the last day will be April 15th, 2025. Again, unless Congress changes something, we haven't really seen any movement on that, but that may be a topic of conversation if the IRS still sees that they're getting a lot of claims that they don't think are eligible. Note that you also do need to amend your income tax returns. Essentially, the ERC, while it's not taxable income, you have to reduce the credit, your wage deduction on your income tax return by the credit amount. So it has the same functional impact as treating it as taxable income. And you have to do it for the year that the credit relates to, even if you're a cash basis taxpayer. The IRS has been very, very clear about that. So, you do have to consider, if you're hitting the deadline, if you're thinking about a late claim for the ERC, you also have to consider the deadline to amend your income tax returns as well. Otherwise, you've got the risk of penalties on not doing that. Let's go to the next slide. A couple of points here. Why does the IRS think so many of these claims are fraudulent, right? And the issue relates really to there's two ways to qualify for the ERC, one of which is causing most of the problems. The first is whether if your operations, you qualify if your operations were fully or partially suspended on orders from a government authority due to COVID-19, and the business no longer qualifies when the relevant order is lifted. But what it means to be fully or partially suspended is a much more limited thing than a lot of people are saying out there. So you've always got to be sure of the dates. Again, if someone's telling you qualify all the way through Q3 of 2021, think about the difference in the impact on businesses of government orders in April of 2020 versus September of 2021. Very, very different world. And you've really got to make sure you understand that you qualify based on a government order that impacts you all the way through. The IRS on audit is looking for, circle that government, show us the government order, circle where it impacts you, and then show us when it's lifted, because that's when you stop qualifying for the ERC. You can also qualify based on what's called a significant decline in gross receipts. This is based on a calendar quarter. You're comparing quarters in 2020 or 2021 to 2019. You need a 20% decline in 2021, which is somewhat more generous. You need a 50% decline in 2020 to start qualification. And again, there's details on how exactly you kind of consider that. We'll talk very, very little bit about that, but I don't want to bog this down here. Let's take a look at the next slide. So here's, again, I want you to take away, if you're thinking, look, I've qualified for the ERC, I definitely qualify. If you think you qualify based on the things that are on the slide, that's where you may want to start thinking again. And the IRS has been very clear recently. Do all businesses qualify? No. And do general stay-at-home orders qualify a business? No. That a stay-at-home order does not shut your business down. You need to show that if you could operate, you would need to show the decline in gross receipts. Do CDC and OSHA guidelines qualify a business? No. Those were recommendations. And again, kind of think about it, right? If CDC and OSHA guidelines qualified a business, go back to that number one, every business would qualify, right? And that's simply not the case. Do issues with your supply chain qualify a business? No. Qualification on a supply chain is very limited. Circumstances are rare. The IRS, actually, that's one thing the IRS clarified recently to make it really clear of how narrow the supply chain exception to qualification is. The other thing you want to show is you've got to be able to show that the impact of government orders, the impact has to be what's called more than nominal, but more than nominal based on IRS guidance is a greater than 10% impact on a business's ability to provide goods or services. That's a very, very significant number. And again, for some businesses, this can be very, very difficult to quantify, but the IRS is going to be looking for some form of quantification on audits. You want to be thinking about that. Even if you have government orders that are still impacting you, you've got to be able to show, okay, how much did this limit my ability to provide? Again, keep thinking about that. It's really a limit on capacity. Just showing that your gross receipts went down 10% doesn't necessarily prove anything if you were capable of providing more. That's the question. Were you limited in your ability to provide services and then essentially kept your employees on? A couple of other small points here. Let's go to the next slide. Just a couple of takeaways that I want to kind of get across. There's a lot of other details about the ERC. This is not an extensive, we've done many presentations on the ERC, and there's a lot of information on our website. If you filed a legitimate claim, don't be concerned. If you have worked with a trusted tax professional and you've got well-documented and supportable eligibility work papers, you should be fine. Again, the issue really here is about timing, right? If you're just getting around to it now, or you're submitted not long before the IRS paused processing, the likely answer is the IRS is going to be quite slow in processing the return. If you didn't work with a trusted tax professional, now's the time to review eligibility in your credit calculation with your trusted tax advisor, and consider identifying and withdrawing an improper claim, because it can provide significant savings and penalties and interest down the line, as opposed to getting audited. That's our time. So thanks everyone. I know there are some questions. We'll try to respond to them afterwards. Oh, and we got to get one more polling question. A business can still apply for the ERC. Answer is yes, you still can. It's interesting. I think the IRS, my personal feeling is the IRS has wanted people to think, maybe, can I? In part because they want people to slow down and really consider, do I qualify, and work with a tax professional that is going through all of this with them if they believe they qualify. So thank you, Joel. Thank you, Joel. Thank you to Nick as well. If you have any questions, feel free to email us. Again, we'll try to respond offline to any of the questions that are in the chat. So thank you all for joining us, and have a great day.
Thank you to our speakers, and thank you to everyone attending today's webinar. Please remember to complete the short survey prompted at the close of this webinar. A recording of today's webinar and a copy of the PowerPoint slides will be made available to all attendees via email within the next few hours. CPE credits and certificates will be issued within 8 to 10 days via email. Thank you again, and have a great rest of your day.